Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Next up, the Planet MicroCap Showcase Vegas, happening April 30th through May 2nd, 2024 at the Paris Hotel and Casino. Save that date. We are working our tails off behind the scenes to put together the best program we can. And the website is now live. So if you'd like to register to participate, please visit planetmicrocapshowcase.com. See you in Vegas. Now, my guest on the show today is Chris Satterthwaite, Senior Analyst at Verdad Advisors. The team at Verdad put out a phenomenal weekly newsletter, and they recently published one titled "The Death of Small Cap Equities?" And we've been talking for a while here about all the various issues plaguing the small microcap space. And I wanted to invite on Chris to share the research that the Verdad team have uncovered. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my interview with Chris Satterthwaite. Chris, thank you for joining me today. How you doing, man?
Yeah, I'm doing great. Thanks for having me on. Love the content you're putting out on the small microcap world. We're obviously big believers in the space, and I think despite our article, which we talked through, we are big believers in microcaps. So look forward to getting into it.
Oh, absolutely. I mean, I subscribe to your newsletter. I get it, every time you guys put it out. And the one that we're going to be talking about today definitely stood out. So it was great. I hit up Dan immediately because he's hilarious, dude. I think we did an interview 2 or 3 years ago where he was like, "Hey, man, anytime you want to talk microcaps, like this is my bread and butter. Like I love it." And so I had when you see a title like "The Death of Small Cap Equities," that's a podcaster's dream sexiness title that we have to hit each other up and do what we do here. So here we are. So Chris, let's dig into this article a little bit, because I think there's a lot of really interesting information. And just to be clear, it's the death of small cap equities ? Not a full declarative statement for anybody that we don't want that, obviously, right. But let's dig into it. So my first question is just in general, your take on are we in this? What does the death of small cap equities mean to you? Let's start there.
Yeah, so I think I've been around the small cap space for a while, and I think there has been an extended period of underperformance relative to large caps that is worth examining. What's driving that? And I think there's a bunch of different hypotheses. Is it something structural? Is it cyclical? And I think for us as investors, it's a question that we spend a lot of time thinking about and exploring. And given that we're on, the cusp of a pretty extended period of underperformance here, I think we thought it would be interesting, and we've heard this hypothesis that, while small caps tend to be cheaper and deliver higher returns over a very long time period, that recently being over the last 20 years, there's been a decline in the quality of small caps. And so we thought, we've built this really kind of cool, exciting database that we can kind of use to do a lot of this research. And so one of the projects we decided to do early on was looking at this question of, has quality changed over time for small caps? how does that differ by sector, and then also how does that differ by geography. And some of the analysis we found was we'll discuss in more detail today. But depending on the metrics you look at, and one of our favorite metrics is gross profit to assets as an indicator of quality. There has been a material decrease in the median gross profit to asset ratio over time. And we can get into kind of the nuances around why we use median and what that possibly means. But there has been a decline in quality, which I think begs the question, what do you do with that information? What's next? Do you decide to look in areas that have higher or improving quality? Does that mean that you just have to be more rigorous with your stock selection process within the US? I think those are all valid questions, and people can kind of take different approaches to our research. But in general, our big finding was that, yes, there has been a decline in quality in small caps, especially in the US.
Great launching point. So before we get into some of that data, I think we should clarify a little bit as to why you're using that metric as the main KPI that's telling you that there is a decline in quality. So again, that was gross profit to assets. I mean, I'm sure some people listening are like, well, we know why this is. But for those that don't know why this metric is key to that, love to hear more there.
Yeah. So we, a lot of the work we do is kind of coming up with, we're kind of quantitative, quantamental. So we both look at both fundamentals at a quantitative level, investors. And so we're always looking at different quality metrics. And so some of the ones we might look at are ROA, ROE, so return on assets, return on equity, return on invested capital. And we tend to look at how those variables or those metrics predict returns over time. And I think by far our kind of most consistent and strongest predictor of returns from kind of a quality metric, so not looking at things like valuation or size or leverage, tends to be gross profit to assets. So it's a metric that scales pretty well across industries. Most companies, and it's high enough up the income statement on the gross profit line that most companies are profitable there, so you don't have to deal with a lot of sign changing. And most companies have positive assets. So it's a metric that works pretty well across industries, and it tends to be very predictive of returns, which is why we like it.
Very cool. All right, so then let's now dig into some of the data that you've found. I think one of the things that stood out to me was that there has been this steady decline in quality amongst small caps since the early 2010s. So what would you say is it about the economic environment from that period to now that's resulted in some of those in those results?
Yeah. So it's actually I think that's the central question of this piece, which we don't address specifically in this piece. Is we make the observation, yes, there's been a decline in quality. There's some hypotheses for what might be driving that. But then the natural follow-on, at least to us, which we'll have a piece on in the next couple of weeks, is how is that, like, what's driving that? And so I think there's a couple different hypotheses. One is private equity as an asset class has grown and become much bigger. As that's grown, higher quality companies are either staying private longer or being taken private. And so you have some selection bias in the small cap space where you tend to have the companies that are not good enough to remain, or not high quality enough to remain in a private portfolio or to be bought in a private portfolio. And therefore you have a little selection bias. So one hypothesis is that the emergence and growth of private equity is leading to some selection bias in terms of what goes public at a smaller stage. The second is that second hypothesis is that there is something structural that's changed about the profitability of small cap companies in the US specifically. A third would be that it's cyclical and it's related to just where we are in the macroeconomic cycle. Smaller companies, if they're earning higher cash flows, might be more inflation proof, and therefore in a period of very low inflation, you would see perhaps less returns associated with those companies. Those are three hypotheses. Another one would be And then the fourth would be mix shift. Is there a change in the mix of sectors? So is the small cap universe shifting towards lower profitable sectors like biotech? And then finally, is there a mix shift in terms of the types of companies that are public? So is there a greater proliferation of newer entrants into the market that happen to be lower quality? I think I have less of a good answer to the cyclical and structural questions or hypotheses. I think there's definitely on the private equity side, there's more active participation. So it's plausible that private equity companies are staying private longer, especially higher quality ones. But I think most immediately answerable is the question of mix shift. And we'll have a longer piece on this, but it does seem that the primary driver of the decline in small caps is the decline in quality of new entrants into the markets. And so we've done some analysis on this, particularly in healthcare. So healthcare, that's excluding biotech and pharma. Biotech and pharma on their own, and then those are I'd say two of the worst culprits of new entrants into the markets are coming in with incredibly low profitability on a gross profit to asset basis. So I would say it's primarily a mix shift, although within the small cap universe, and we looked at companies that have kind of remained in the small cap universe for a long time. So and I can describe this analysis in a little more detail, but there has been a decline in quality even amongst those. And that's, I think, a bigger question. It's more muted than when you look at it on an overall basis, including the new entrants. But there has been a decline just within the kind of core of the small cap universe that we're not really seeing as much in the large cap space. So that's an open question.
Absolutely. I mean, that everything that you just said kind of fits into some of the anecdotal evidence that I've seen, that a number of my colleagues have seen, or that I've even done interviews about over the last couple of years. And that's been the shift in mentality from where, when the dream has always been, I build my business to a point and I take it public. Like that was the shining beacon. Like, wow, we took our company public. Like that, what an accomplishment we did. And it seems that mentality has shifted now. Like, all right, well, I guess we're going to go public because we've exhausted all our other ways in which we can raise capital privately. I guess let's just do it. Like that's something I just don't know how you change.
Yeah, no, I think it's a good question. I think the requirements to be a public company are pretty high. I've talked to a lot of small cap management teams over the course of my investing career. And I think when you're a small cap company in the market competing, you're competing for investors' dollars with the likes of really big companies. And it can be really hard to get your story out there, especially when you've got, flashy stocks like I don't know, any of the meme stocks. Like there's just a lot of competition for eyeballs on investable dollars, and so it can be really hard. And I think if companies have easier opportunities to access capital, like through private markets, the pitch to be a public company is a tough one.
100%. But I mean, I think that kind of does speak to the structural issue, right? Because one point that you made in the article here was that what was it? Where is it? Right here. That the Russell 2000, 16% of the index is made up of unprofitable biotechs, which is an 11% increase since 2006. I mean, there you go. I mean, like bang, like that. Yeah. That kind of explains it all right there. Like the Russell can't even. And that's with using their age-old criteria. That's not even with any kind of adjustment. That's just straight up 11% increase. There you go.
Yeah, and I think if you look at the premium, we spend a lot of time looking at the Ken French data library where he breaks out his kind of factor returns over time. And so if you look at the historical premium associated with owning small stocks and value stocks, it's been really significant, and to the point where you could say, these factor exposures, there's something structural about them where the market is underappreciating, the ability of these companies to generate profits, and there's kind of there's too much pessimism surrounding these types of stocks. But with the index shifting to something like 16% of it being unprofitable, and the mix of small cap stocks becoming more unprofitable, it does beg the question of, if you include a quality factor in there, would that help explain some of the difference in return that we've seen, the underperformance of the small cap index? And we think that's a plausible explanation.
Why do you think the Russell won't change their criteria? I mean, I know some people probably listening and be like, Bobby, like, what kind of dumb question is that? But like, I don't know.
I think it's a totally reasonable question. The S&P mandates that you have to have positive net income or EPS over a certain time period. I don't think that's an unreasonable expectation to have of companies that are included in an index. I can't speak to why the Russell 2000 index doesn't include that. But I think if over time, if the mix has shifted from 5% to 16% unprofitable biotech and pharma, and by the way, like the biotech and pharma space has been annihilated over the last couple of years. Returns have been really poor. I think eventually the performance of the index will probably force them to reconsider. But it's pretty heavily tilted towards some unprofitable industries, which explains why the index is underperformed.
Not to jump around here, but I just thought of something going back to, when we talk about the environment and one of the reasons for why this has happened, and talking about private equity as an asset class, something has to change there. And I think it already is starting to change a little bit in terms of the perception of, private equity is now, getting money from private equity, all that kind of stuff. Because I think one thing that maybe some managers are starting to realize more and more is that if you think about there is additional costs with going public earlier in your life cycle that maybe you didn't expect, or that just you weren't prepared for. But in some ways, you almost have more control than if you are going to go the private equity route, especially if you are able to retain, if you do have a large ownership of your own business and you want to still do it that way in order to grow the business. I think there might be a little bit of a shift happening there. I'm not sure if I'm speaking kind of, again, anecdotally. So let's hear your thoughts on that.
Yeah, Dan, I think Dan's the one here who probably has the most well thought out perspective on private equity. But what I can say is that, the period in which private equity's returns were the best were when they were buying companies at very cheap multiples that tended to be smaller than the companies they're buying now, and also putting on less leverage. Maybe taking private equity capital has been a great deal for companies that otherwise would have been public over the last 5, 10, 15 years. I would say, now the situations that a lot of portfolio companies are in private equity portfolios is pretty different. There's probably much higher interest costs that have to be covered. And I do not envy being a CFO or a CEO at any private equity portfolio company right now. I'm sure it's quite tough. And so, while the environment might have been great for the last 15 years, and maybe it's still attractive to take capital from a private equity firm, I think, either it's going to become harder for the portfolio companies or it's going to become worse for the investors in the private equity funds. I don't know which one is going to happen first, but I would suspect that after the sudden increase in interest rates, companies will think twice about taking an investment from a private equity firm, because that is expensive capital, even if it's been cheaper capital over the last 15 years.
For sure. So now getting to the cyclicality of the markets, and while the title that we're talking about here today, the death of small cap equities ? Some contrarians are hearing that and being like, "Oh, great! This is great. Keep putting out content like this, man. Like I'm just gonna keep finding more and more deals out there. Like, please, yeah, tell everybody how much small cap sucks. We love this, But I mean, like we said, markets are cyclical. I personally don't think small caps are dead by any means, but how long do you think this period, I guess, of just I guess struggle or negative sentiment do you expect to continue for?
Well, I think the question is pretty muddied by the percentage of unprofitable companies in the index. I mean, I think if you were to say, what does the forward return look like for the index as a whole, given how, so maybe to backtrack, we are strong believers that a couple of the biggest determinants of your return looking forward are going to be your acquisition price, so the multiple you pay on entry. Um, we think size and quality are two other important factors. So we think there's a greater dispersion of outcomes among smaller companies. And so if you can carefully build a portfolio among smaller companies, we think you can do better. And additionally, we do think there's a premium you can earn for buying higher quality companies. So the index as a whole today is comprised of more unprofitable companies than it used to. So given that fact, that are also much more expensive, given the fact that they don't generate profits, one of the ways we look at profitability is we look at EBITDA to EV, which is kind of the inverted of EV to EBITDA, but it allows us to capture on a similar scale companies that have negative EBITDA. And so when you look at our small cap universe, the median profitability metric, EV to EBITDA, if you include the unprofitable companies, is something closer to like 12 or 13 times. So it's actually quite expensive. But when you exclude the unprofitable companies, it trades at 8 times, which is what we have in our article. So, for the subset of profitable companies that are have decent quality metrics, so actually we're quite optimistic about the prospects for those, and we think. If you look at the markets like Japan, which are cheaper and have either higher or improving quality than the US, or Europe, which is either on par in aggregate on valuation with also more stable profitability metrics, we're pretty optimistic in both of those markets. And I think within the subset of profitable, high quality US companies, we're pretty optimistic. For small caps as a whole, including the unprofitable segment, I think it's hard to earn a good return when you're buying companies that generate no gross profit. Like it's really a coin flip on drug trials and outcomes, which at least from our seat is really hard for us to have any view on. And I think just the expected return for those types of companies is not good.
Very good. One thing I also wanted to bring up in the article that you mentioned, how in this one line, you said that the trend is in declining quality is most evident in the United States. But when we look at Japanese or European markets, we see much more stable or even increasing signs of quality among both large and small caps. Japan in particular has had stable gross profit to assets and impressively increasing ROAs over a similar period of time. That was an interesting find.
Yeah, no, it was. I think the most interesting fact. I mean, when we saw this declining quality trend in the U.S., our next question was, is that something that's happening overseas as well? Because in that case, it might suggest it is something structural. And what we found, at least in Japan, was that actually it's been the opposite. Small caps have had improving quality metrics. The caveat being, when we start the analysis is important, and the Japanese markets in the early 2000s were not in a great spot relative to the US. And so there's just been a bit of a reversal in the trend. Japanese stocks have been improving while the US stocks have been declining. But in general, we're really excited about Japan. It's obviously had a great run, but the quality metrics are really solid. Japan is cheap on just about every metric you can any valuation metric you want to pick. And not only that, but we've also looked at it across sectors. And in pretty much every sector, Japan is very cheap. It's not concentrated in any one sector. So, that's a market that, just given our focus on valuation, quality, and size, we're very excited about.
It's funny you mentioned that, because I've we've been doing a lot of content covering Japanese
I
microcaps.
I just watched one of your last podcasts on it. Yeah.
Oh, you did? Oh, yeah. David was really good. We're actually, I think, going to be doing a panel in Vegas with like their top tier picks
Nice.
of Japanese microcaps. So that should be super interesting. We're gonna get the translators. We're gonna make it happen. We're gonna figure it out.
Awesome.
But again, to follow up on the markets are cyclical aspect of this, and what would you say are some of the data points or KPIs that would signal a change in sentiment in small cap equities in the United States? Because that's clearly what we're talking about. It's like the US is the problem.
Yeah. I think so there's a couple, I'd say there's kind of like fundamental metrics that we would look for. And then I think there's some kind of more technical ones. And I think on the fundamental side, within the basket of, I will say, profitable kind of core equities within the small cap universe. So those that are not like recent entrants, there we'll look for, revenue growth has actually been quite solid. So I think that was one area where we were kind of surprised to see small caps and large caps, kind of the median revenue growth is right on top of each other, but there has been this divergence in profitability. So whether that's related to, a harder time absorbing some of the inflationary costs that large caps maybe have more pricing power and are able to do, I think one thing we would look for is kind of improving profitability in that small cap segment. But another important one is, there's been very little in the way of positive inflows into small cap equities. And I think that's a pretty important barometer for a shift in sentiment, is seeing positive inflows, which we haven't seen in a while. So in the meantime, we're happy to own really cheap businesses at really attractive free cash flow yields, great dividend yields. But, so we're kind of biding our time owning high quality, low cost businesses where we get paid something to own them until we think that the sentiment's starting to change.
So let's talk about maybe some of the sectors that are interesting to you guys right now. Are you like quite a few other buy side managers that I've talked to that are putting together a little healthcare biotech basket strategy as we speak, or anything else interesting?
So not healthcare and biotech. And while you're speaking, I just want to I'm going to pull up our kind of cuts by sector to see. I thought
that would give you a good laugh, because I mean it's interesting. There's quite a few guys right now that I've just had meetings with in the last like month that are like, Bobby, can you like not talk about this like too much on your pod right now? Like we're all kind of, we got the strategy going on for us. We're hoping nobody else is kind of looking, Yeah. I'm like, don't worry, you guys are the only ones. Trust me. Like,
no. So I think the things that we're excited about. So I think in addition to the kind of biotech pharma, concentration of unprofitable companies, there's two other sectors specifically within small caps that have seen a really significant deterioration in kind of quality, or our gross profit to asset ratio. So the other one would be healthcare, which we talked about, and that's also coincidentally where you've seen a lot of private equity activity. So private equity, I think, relatively is most exposed to tech and healthcare, which are the two sectors within the small cap universe where we do see the greatest deterioration in quality. So healthcare and tech, those tend to be some of the more expensive, lower quality sectors. So that's where we're spending less of our time. I think the ones that we are more excited about, energy for a while has had really attractive profitability ratios. You are obviously dealing with coming off of some COVID peaks, so there's some gives and takes there. But consumer staples and industrials are two others where we think the valuations have been pretty reasonable, and the quality metrics are much more stable. So I'd say maybe it's worth just pausing on one note, which is, given the title of the article, "The Death of Small Cap," is it the death of small cap equities? ? I think one thing that is hopefully a point of solace to some of your listeners would be, given that the aggregate quality of the index has deteriorated and there's a greater proliferation of unprofitable companies, I think it actually, the takeaway is not that, investing in small cap equities is now a loser's game, and it's the deterioration in quality is kind of the foregone conclusion that you're going to earn poor returns. I think this actually, it's now more important than ever to be really diligent about the portfolio of small cap companies that you're putting together. And, it's not sufficient to just buy the Russell 2000 index, given the change in the composition of it. It is important to now spend the time to find high quality, underappreciated, underfollowed businesses that are trading at cheap valuations. Because there is now real dispersion in the quality of the index. It's not just all the same homogenous small cap companies. There is real differentiation, and I think taking the time to build a portfolio of companies on the higher quality, cheaper side of that universe is actually going to be really additive.
I think we just covered. Geez, what a nice little stamp on it all right there. So, final thoughts, I guess. We covered quite a bit with this article. I'm excited to read the follow up where we get into some of the reasons for why. We kind of went into it earlier on in the interview. But final thoughts. On the death of small cap equities ? And how we should think about that maybe going into 2024.
Yeah, I think this, 2023 in part has been defined by, and this is probably true for the last, 10 years or so, but extreme concentration of returns in a handful of stocks. So some of the mega cap stocks have dominated the headlines. They've also, given their size, dominated returns. And I think it's worth asking, is that's a really interesting phenomenon that's kind of new. And so it's worth exploring. Is there something structural that's changed about the concentration of returns in market? Is there any value to being a small cap investor given the change in composition? And we think there absolutely is, but the answer is not buying an index, setting it and forgetting it, given the change in quality. We think the answer is, you got to go to where the companies are cheaper, higher quality, undercovered, underfollowed. Where can you find the diamond in the rough, so to speak? And we think the places we see that right now are primarily outside of the U.S. And then within the U.S., it's of the companies that are making money right now. It's not in biotech, not in pharma, really not in healthcare, and not in tech within the small cap universe. Large caps are a little bit different. So that's where we're spending our time and doing more research. And we're excited to share some updates, and we'd be happy to talk about it anytime again.
Very cool. Well, Chris, with that, where can our audience go and follow you, Verdad, as well as subscribe to the Verdad letter?
Yep. So our website, verdadcap.com, you can subscribe to our weekly newsletter there. Every Monday, we send out an update on research we've been working on. It's a great chance for us to share what we've been researching. We always get great feedback from the newsletter. And a lot of our kind of follow-up topics come from readers just sending follow-up questions. And when we kind of have clearly hit a nerve on something, which this piece did, we'd love to dig in a little deeper. So verdadcap.com is a great place to go and find our research and subscribe to the newsletter.
Very cool. Well, Chris, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I truly look forward to our next update.
Yeah, my pleasure. Thanks, Robert. Thanks for having me.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.